Hello, and welcome to a weekend edition of Real Day Trading. Well, what you are looking at right now is SPY. This is the daily chart, and what you can see here is a ton of convergence around major support. You have a support line coming all the way back from April of 2020, right up through here, bounces there, never quite get there. You have one that starts back in July, has several touches here, comes across, bounce, 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 another bounce. You have one that is an smaller upward trend line here, back from a few days ago on January 25th. And they all converge. They all converge pretty much right where we are, right around 432, 431.50, somewhere around there. And this support is so strong that what it has done is a lot of traders, myself included, a lot of other professional traders that I know, have been going and taking bullish positions off of this support line. Many times that pays off, right? Here, bounce, bounce, way bounce here. Here, though, what is happening and what we don't know is the Ukraine invasion priced in? Because what we have found out is that the likelihood of a full point or a half point even interest rate increase in March is dropping. And it's more and more likely we're going to get a quarter point, and then they have the odds on that, and that's been going up repeatedly. Normally, that alone would have sent this market skyrocketing, almost to all-time highs, if not exceeding them. Back here, that was the news the market is waiting for. The market is waiting for that news. They're scared that there's going to be a very aggressive hike in the rates. And they were hoping, and it was very unlikely because it was almost like 75% chance, it was half a point or higher, that that would happen. And then it turns out they are much less aggressive. But why are they less aggressive now? They're less aggressive now because of the international conflict. International conflicts like that tend to have the effect of easing inflation, and because of that, they do not need to take such an aggressive stance on monetary tightening. That should have sent this market skyrocketing. However, what we have is uncertainty. We have uncertainty around the Ukraine situation. And we also have uncertainty as to whether or not it's priced in. If Russia invades over this weekend, on Tuesday, do we drop below the support down to here, down to the 420s? Possible. Do we have an initial drop and then bounce back up? More likely. There's an old saying of buy the moment you hear the first cannon fire, which, there'll be a huge dip at the start of a war, and then it always goes back up because war is good for the economy. Not good for the people in it, but good for the economy. So there's this constant bullish bias and a constant rug being pulled. You can see here on the 5-minute chart, every time you get SPY here, Thursday, starting to look like a recovery, the next day it gaps down, right? And then every time there's some good news, it starts to head back up and then down again. Starts to end on a good note, down again. And this market was so starved for news that even the notion that two ambassadors or our Secretary of State were going to meet was enough to drive the market up. So this is an ideal situation usually for traders to buy the dip, right? Now, I am usually not a dip buyer. It's a weird phrase, but I tend to buy into strength. I buy at all-time highs. I add as it even gets higher. I don't believe in buy low, sell high. I believe in buy high, sell higher. However, in this situation, it can produce such a violent reversal at any time that the returns on buying the dip in the situation tend historically to be worth the risk. That might give you some insight behind the decisions that were made in this challenge. As for the challenge, and we're going to go through the mistakes and some of the winners. One, I hope everyone who is following this challenge either was following it for educational purposes or was taking the advice of only trading one share and one contract. I've said repeatedly, unless you have had 3 profitable months in a row, you should only be trading one share and one contract at a time until you can get your win rate and your profitability up to a level that allows for bigger position sizes. So if you are doing that, then, and you follow this entire challenge, you probably lost maybe $100, $200. You should not have lost more than that. If you did, and you were aggressive and followed even the number and position sizes, then, well, one, that sucks. But two, I hope you, moving forward, reduce down to one contract, one share, and begin to build using that strategy. So let's take a look at what happened and where we go from here. So I am going to start over at TraderSync. So here's our log. Here was our best trade so far. It was an FDX put debit spread that we entered on February 11th. We exited this on February 14th. And let's take a look at it. So FDX here. Let's go to the daily chart on FDX. You see here, this, by the way, was a 237.50 and a 227.50 put debit spread. Okay. So FDX here. Okay, here. FDX, very bearish chart. We entered this on February 11th, which would have been right here. It broke below its algo line, which is why we entered it. And it continued down. We exited on February 14th, which was right here on the Monday. It had dropped down below our original price, and we took a decent profit on this. We could have held this. We could have held this to expiration, and if we did, if we held this all the way to expiration on February 18th, we would have gotten $10 profit. It cost us a total of around, let's see, $2.73. So this would have been a $7.27 per. So this would have been a $2,100 profit instead of an $863 profit if we held on to FDX until the end. So the mistake on FDX, even though it was profitable, was because I normally do day trading challenges, right? I do challenges where you're constantly updating your positions. These type of challenges obviously require a somewhat different mindset, which is you need to hold these positions longer. If you're under PDT, which I haven't been. So if we would have held this, obviously we would have had much, much better return. Okay, let's take a look here at our next trade. MU, we bought calls on February 11th here, and on February 9th, and we sold them on February 10th. We bought them for $2.44. We sold them for $4.50. Pretty much close to a $2 return, a little bit more actually. And we had 3 contracts. So let's take a look at MU, and these were 86 strike calls, right? So go to MU here. MU, we entered this on February 9th, which would have been right here, February 9th. We exited this position on February 10th at around 9:30 in the morning. So it was somewhere around here. Obviously, if we held, right, all the way to, and expired on February 11th, by the way. So expired here. If we held it to expiration, we would not have gotten more. It would have been down here, right? So that was a good exit on MU all around. So nothing wrong with that trade. NVIDIA, another winning trade. Those are top 3 winners we'll take a look at. NVIDIA, once again, we entered this on February 4th and exited on February 9th. It was a 245 strike. Let's take a look at NVIDIA. Okay, and we entered this on February 4th right here. This is February 4th, and we exited on the 9th, all the way up here, pretty much at the top. Again, could not get much better on entry and exit for this play. This one worked out really well, and we caught the top end of NVIDIA. Great. But now let's look at the top 3 losing trades. Here. Okay. Ouch. AMD. Right here. So, AMD, we entered on February 15th. Added on the 16th, added on the 17th, added on the 18th. By the time it was done, we had an average cost of around 94 cents, somewhere around there. Right. Okay. So what happened with AMD? Let's take a look. First, let's look at the daily chart. This is why there was continued bullish sentiment on AMD. Look at this. AMD continued to bounce off its 200 SMA. No matter what the market threw at it, AMD would not close below this. What does that indicate? It indicates that on any day that SPY would bounce, if SPY bounced on any day, AMD was going to bounce with it. Let's take a further look at AMD. Here. AMD, if you look over through the week, this is relative strength. Here's where we entered, by the way. AMD, with 1 day exception, and a little blurb here, is all green. So here you have a stock that is strong against SPY, that is bouncing off of its 200 SMA down here each time it tries. And you have SPY bouncing off of its support. So basically, you buy it here, right? And here, this is where you could have and should have, I should have had an exit. This is where the mistake is, right here, right? Because even though I have AMD dropping, It did not have relative strength here. And this would have been the proper exit for that trade. But the moment we saw a bounce in SPY, look what AMD did. It jumped up. Okay, so now it hits 118. It keeps us in the trade. Another argument, again, can be made, unstable environment, should have exited here at 118. It would have only been a small loss. I held the position because I am looking at extraordinary relative strength on the stock, a stock that has very strong support, and a market that is bouncing on any piece of good news. What happens the next day? We gap down and drop. At this point, we have options that have lost a majority of their value. So I could have taken the 75% loss at this point. I chose instead to increase the position to lower the cost that would allow any bump in AMD to bring us back to even. That was also a mistake. The bigger mistake overall was that this position started out as a call debit spread, and seeing as how the next day we gapped down with it with relative weakness, I bought back the short side of that, and instead I should have just let the call debit spread go forward, taken the max loss on that if I had to, or exited early, but it would have been mitigated. It would have been mitigated to, 6 positions, 80 cents each. So what wound up happening was too large of a position size in a trade that was relying on the expectation of a SPY bounce rather than the confirmation of a SPY bounce. This trade obviously was the biggest mistake of the challenge. Next, let's just take a quick look, by the way, at a position I could have recovered the entire contract on here Friday. Amazon. We did a butterfly on Amazon roughly at this point here, right around here. And our butterfly was 3,000, 325, 29.75. If Amazon got down to 3,000, we would have profited $2,500 per contract. We had 2 contracts. That would have been a $5,000 profit for $360 spent. And basically, we would have been even. Right around here, around 319 when it hit, that position was up over $1,000. I did not exit it because, 1, I'm seeing a weak stock, SPY is dropping. 2, all I'm thinking at this point is $19 more down, and we're even on this challenge. That impacted my decision. It should not have impacted my decision. I probably should have just taken profit right here, right? If I did, we would have about a $1,400 swing in the account right now. We'd be at around $1,800 instead, $1,900. But what happened was SPY never really got there until the end of the day where it started dropping, and by then it was too late. And all I could hope for at that point was right around here. We just had $30 more to go. $30 more. If it went down $30 more, we're even on this challenge. That's all it would have taken. One butterfly. So we got close to bringing the entire thing back up and starting fresh again on Tuesday. We missed it by around, we wound up missing it by $53 on Amazon. But even on that candle alone, we missed it by $39, $40. Um, so that was a good trade. It was the right trade. We took profit on the Google butterfly. However, the reason I also didn't take profit was at this point in time here, I also had a forward um, position on the other side that was going up, and I only had one day trade left. So could not take profit in both and had to wait to see which one was going to pan out. So that also created a little bit of a dynamic of have to bring them both to the end. But let's be honest, when you're throwing Hail Marys, you're throwing a Hail Mary pass, right? So you're waiting to see is it going to come through or not. Um, but one could argue I had almost 500% profit here. Well, actually, I had 500% profit here. Probably should take the profit when you have 500%. Okay, back here, turn to sync. Um, Apple was another losing trade, and that one was on the same day. It was a Apple 170 call. There was pretty good reason to believe, and if you notice, once you get down here, not many of these losses are very big, but these two combined kind of did us in. And we can go to Apple here, see why we made that trade. Apple. And go to the daily chart on Apple. Again, you have a stock bouncing off support, bounce, bounce, bounce. Has some resistance up here, but relatively strong to the market. Go over to the 5-minute on Apple. You can see the stock in the morning, even though SPY was dropping, Apple is staying very strong. Right? Eventually it succumbs down here. Pops all the way up here on a open and then drops again. So Apple was a stock that was well above, but around close to $2 above in the money when we took the option, and just was a slow drain down and never quite got back to where it needed to be. An exit right around here for a loss would have required using a day trade. The problem with the trade wasn't the trade itself, it was the fact that it was a lotto trade that ended the next day. So I could not use a day trade on it here. Had to wait till the next day, and by the time we get here, you have options that are pretty much worthless and not worth cashing in. So those were way too risky in a bearish market to do bullish Apple lottos. Okay. And then finally, the third largest here, Facebook, and same thing with J&J, but Facebook, we enter this on February 8th on Facebook. These expire February 11th. What are the daily on Facebook? There. Okay. Entered it here on February 8th down here. However, the next day, it finishes above its support line, so I exited it for a loss. I exit for a loss here because it finishes above the support line. This is not a mistake. This would be the same way as if I was long and it finished below a support line, you should exit. So here I do exit, and it turns out Facebook would have continued its drop down, but these expired on February 11th. And on February 11th, it never really got below support here. So we exited this for a loss. However, I do not think there was really any fault in the trade. It was a good trade to take down here. It pops here on some news, and then it did not continue until the next week. This was a call debit spread and expired here. So I do not think there was much that could be done on the Facebook one, the Facebook side. The number of longs here far exceed the number of shorts in a bearish market. And so that was another mistake in the challenge so far, was too many. I was too slow to switch over to the short side, but that is again because you have SPY bouncing off support in a market where you're getting tons of financial good news. It's the moment you have the shackles of the Russian invasion lifted, well, SPY pops and jumps up. It makes it very dangerous to go short when you have the market at its low bouncing off support. In fact, most traders are going long at this point. Most traders were. All the sweeps were long. Every pro trader I know is going long, and a lot of people got burned because what should have been done, and the real answer here is this type of market should not be traded. It should only be day traded. Day trading this market, great. Lots of volatility. You can do great day trading it. In fact, in every day but one, I did really well day trading this market. But swing trading this market, that is a Sisyphean ordeal. With that said, we're not dead yet. We're at $500, so we're on life support. If I can take 500 and push it up, that would be amazing. I am going to leave on the call debit spread here for AMD. Again, it's still one of the stronger stocks. I am going to leave on this Ford $19 call and these hook $5 calls. All three of these, if the market is strong next week, will be strong. With $500, I could either let it sit there, or if I have any type of SPY increase, these are the three stocks I want to be in. If that doesn't work, then I am going to have to do, I believe, a 5K to 20K challenge. The 5K to 10K to make up for the 5K that's lost, and then 10K to 20K to wind up 10K up in profit. So that is going to have to be the challenge. And my hope is that one way or another, we're going to get direction with the foreign market that will tell us where we're headed. I believe once the invasion is announced and once it occurs, we are going to get a dip, and then we are going to get a significant bounce back up. So if that happens, it'll provide an excellent opportunity for a number of bullish positions at that point, once support has been established. However, if SPY continues to drops below 430 and heads into the 420s, at that point, we're entering very bearish territory. And what you're looking for then is a continued sustained selling. Now, day trading a bear market is in many ways easier than day trading a bullish market. Things drop faster than they go up. Swing trading a bearish market requires, and here go back again to the issue on the challenge. It is very difficult to swing trade bearish positions in a bearish market. You can swing bearish positions on stocks that are extremely weak against a choppy market, against even a somewhat bullish market, because the stock itself is inherently weak. But bearish markets have violent reversals, and they drag stocks back up with them. It is very difficult to swing trade a bear market because you never know where the price point that a large enough a critical mass of stocks will become attractive enough to institutions to start buying them up. And maybe when we hit 420 or 410, it could be anywhere. It could be 400, it could be 415, it could be down to 390. But at some point, institutions look at those prices and go, yeah, this is where we want to start buying and accumulating. You don't know where that point is. Now, normally you can use technical analysis to get an idea of that point. And we will use that. But when we're in such a news traded environment like we are now, technical analysis goes out the window. The only thing that shows there is some sense of rationality left to this market is this, that despite all the news, they're in a holding pattern right here. And what it turns out is this isn't actually bouncing off support so much as it is in a holding pattern, like a rocket on a launch pad. We have bad news. They don't like the news. Fine. Down we go. We have good news. Maybe it's a limited invasion, sanctions are put down, but it doesn't look like it's going to spread. Okay, now the market can digest the lower interest rates and up it goes. Then this becomes a launching point. So it's a very critical juncture in the market. There's a number of people I know that are long the Qs at the moment. They're willing to take some heat on Tuesday if this drops because they feel we're going to get, again, a violent reversal. And that is the other issue, which is this is a trading technique that isn't generally discussed in training manuals on trading, but traders a lot of times will depend on the prospect of violent reversals. They'll take heat on positions knowing that at some point in the next few days or whatever weeks, you're going to get such a reversal on this, a buildup, they'll start a short covering and then off it'll go. That it's a risk-reward proposition. I improperly played that on AMD. And you saw, by the way, on Friday, AMD quickly became the strongest stock pretty much in the market, going from $10.60 all the way up to $16 within an hour. An hour, almost a 5% increase in the stock, and within an hour on AMD, right here. And then stabilized. That right there, that's the hidden strength of the stock that we were banking on. But it came right at the end, too late. This came earlier in the day. This came the day before. We would have been fine probably. But it did not. So there was a combination of elements that caused the decline in our account, but there was also mistakes in not exiting at certain times. However, I wanted to go through it and kind of give you some idea of these mistakes and what they are. Moving forward, I am going to take, including if we do a 5 to 20, a very boring approach. A approach that buys spreads, and instead of taking profit on them, we're going to bring them to fruition. We're going to cut losses far earlier on them, and we're going to nurture our winners far longer. That is going to be what we're going with for if we do a 5 to 20. and we're going to have far less positions. So there'll be less positions, a reserve of cash to use. I was using all the buying power. There'll be a reserve of cash to use and less positions going forward in a 5 to 20K challenge. Once again, if you are following these trades, which you should absolutely not be doing, you shouldn't follow anybody's trades like that. But if you are, because in reality is some of you will, you should be doing it with one share and one contract. That's it. I keep saying it over and over and over again, and I keep seeing traders that are losing all this money because they insist on using thousands of dollars when they have not yet proven that they know how to trade. So that makes, okay, I lose 5,000 on this challenge. That's like I can lose 5,000 on a trade in my regular account and not even blink. But people following this, if you lose 5, that's a lot of money. So you should absolutely be doing one share and one contract. I do not understand why people aren't doing that. It's insane to me. You've never proven you can be profitable, and yet you're putting all this money in. And it's, oh, well, you've done this several times. I figured I'd just follow. There's no guarantee in this type of market that anyone's going to double an account. There's always volatility. There's always risk every single time. And until you know that you can do it on your own, let's say all of a sudden in the middle of this challenge, we were up over 1,000, or I get hit by a car. Would you know what to do with your positions? Would you know how to trade the rest of it? That's why it needs to be one contract, one share. So going forward, again, unless you can look back and go profitable 3 months in a row, that's what you need to be doing. Cannot say it any more plainer than that. Okay. Well, the rest of you have a great weekend. We will see what Tuesday brings us. And of course, there's plenty of time in this weekend to watch some more videos and read the damn wiki.